If you go back 50 years and plot a bar for each year, graph bar, what's the high that year of the silver spread versus gold? You can see that in 20 of the past 50 years, silver has at least been 2% of the price of gold at some point during 20 of the past 50 years. $8,000 gold. What's 2% of $8,000 gold? Silver's like tripled, quadrupled, quintupled from where it is now. Okay. If silver merely went up to 2% of the price of gold and gold were $8,000.
One of the most significant developments in the silver market is the rising interest from governments and central banks. Unlike gold, which has long been a staple of central bank reserves, silver is now recognized for its strategic importance in monetary and industrial applications. Silver has emerged as a compelling investment opportunity in early 2025. As of February 2025, silver is trading near 3-month highs, around $32.50 per ounce, with some projections suggesting it could reach $50 per ounce by mid-year. Widely followed precious metals analyst MichaelOliver expects a breakout in silver's spread versus gold in 2025, driving accelerated gains in metals and mining stocks. Silver could quadruple in value if gold reaches $8,000 and silver reverts to its historical norm. Reflecting on the market fundamentals, Oliver predicts gold is entering its final explosive phase, where price gains accelerate sharply. While the broader bullish technical picture remains, price, RSI, and MACD continue to trend higher, there is growing evidence of a significant pickup in gold trading activity among retail investors, especially in China. While not enough to warrant turning bearish, along with the topping signal delivered on Tuesday, it adds to the case for near-term caution. In his assessment, Oliver emphasizes that gold miners are deeply undervalued compared to gold and the broader market. He notes that their price relationship has been weak since 2015 but is forming a base. He predicts miners could triple gold's gains upon breakout if this reverses. Barrick, the world's number 2 producer, reports fourth-quarter results, which are expected to include its full-year production guidance. Senior gold producers are already seeing a rebound in their stocks. A Bloomberg index of 10 senior gold miners has soared 31% this year, almost triple the gains seen from spot gold. That is helping the world's largest producers catch up after last year's 11% gain fell short of gold's 27% rally. Now, we present the clips of MichaelOliver's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
We turned bullish based on, well, first off, we've turned bearish and bullish on gold over the past 3 decades. We've been around since 1992, MSA. And we call major tops and bottoms. And in 2011, a couple months off the high, gold dropped just enough, not in price to disturb anybody. But on our long-term momentum, it broke a major trend structure. Went back several years. And yet on price, you couldn't see that trend line being broken because it wasn't there. It was on momentum. And so we turned major bearish on gold, and we had to explain to our subscribers for a year because it dawdled. Gold after topping dropped and then went sideways through early 2013, confusing both sides of the market. You know, is it bullish? Is it not? It was holding, but it never could get back to its high. And finally, it crashed. So we can be bearish on gold. We turned bullish again in February of 2016, and that was 2 to 3 months off the bear low. Bear low was in December 2015 at 1,050. We turned bullish at 1,140. And nothing on annual momentum of gold has caused us to not be bullish. So we've had these zigzags in price, 2-year wide, 2 to 3 year wide range in price, where, 2020 to 2020, early 24, where, it went sideways in a 15% range, basically. Nothing has caused us to be bearish, except to note that these are just pauses or corrections within an ongoing bull trend. If you go back and look at prior bull trends in gold, you'll see that often near the end of the move, suddenly price goes berserk. And in particular at that time, you'll see silver go berserk to gold, where, you've had this arm wrestling struggle on both the monetary metals. 2 steps up, 1 step back for gold, or 3 steps up for silver, 2 steps back for silver, that type of process, which is very tough to weather, but nevertheless ongoing. And then suddenly in that last year, snap, it takes off. And I think we're at that point now. And I think one of the things that will assist in sparking that acceleration in the advance, so a couple up, 2 down, no, it's going to be 10 up, then 1 down, that type of thing, is the breakage in the stock market bubble. Because that money will then seek a new place. And any asset manager with his head screwed on, even now he should realize it, gold's been beating the stock market. It beat it last year. It beat it last month handily. And yet there's nobody pounding the table in headlines on CNBC or Financial News Network or on Fox News, Business News, about how gold is beating the stock market. Okay. There's no emotion there. And I love that. But that's where I think we are. We're on the cusp. But then the issue is, okay, well, if the mama metal's going up, gold, what about silver, which everybody thinks underperforms gold? In point of fact, over the last 12 months, close of January 24 to close of January 25, silver beat gold, percent gain. Gold miners beat gold and silver. Nobody would believe that. They think, oh, no, they're dogs. But no, on a percent gain basis, and even last month alone, miners were at the top, silver was next, gold was third. And then you had some minor upticks in the stock market. But I think the miners are about to be the place to go. And it's not just because they're dirt cheap. They're dirt cheap not only in price, but in terms of their spread relationship to gold. Mining price of the mining sector relative to an ounce of gold. You can plot that as a spread. And the price of, let's say, the GDX index versus the S&P 500. And if you looked at that as a price chart, you'd say, looks like a base. Something's real cheap, doesn't want to go lower. It's going sideways. And treat it as such. And we think there's technical reasons to assume it's going to come up out of that base. If it does, it argues to us that the gold miners, I'm using GDX in this case, relative to gold are likely to triple the upside gains of gold once they break out of that base. Whereas gold will explode, silver will, but the miners will go berserk. Why? They're cheap. They're a stock. Some people don't like to trade silver bullion ETFs or futures. They'd rather be in something in the stock market. And some of these gold and silver miners offer pretty decent, returns, earnings. So I think a lot of that money that leaks out of the stock market, some of it will seek positions in the tiny little gold silver mining sector, which will goose it. And it'll be a reflection that, one, the process of upside in gold is accelerating, and that, two, investor interest in that sector is suddenly woken up.
With inflationary pressures back on the rise, inflation-proofing portfolios remain popular. It's impossible to talk about inflation protection without mentioning real assets. It is an age-old market truism that real assets, particularly commodities, are a standout asset class for inflation protection. Market analysts, including MichaelOliver, say commodities are waking up after years of stagnation, signaling a second wave of gains. He emphasizes that commodities and gold, which previously moved in opposite directions, are now aligning. The good news for commodities is that rates are going higher. Commodities and gold tend to do better during high-rate periods than in low-rate environments. And if we get a surprise resurgence of inflation, rates will tick higher, which is even better for commodities. Soft commodities have done well recently, but it's not an inflation protection story. It's supply-driven circumstances that have driven coffee prices up nearly twofold in the past year. Each commodity market reacts to its own idiosyncratic supply and demand circumstances. Within the stock market, Oliver notes that energy and agriculture stocks, along with gold and silver miners, are poised to benefit. Let's get back to the interview.
Within the stock market, there are areas that look safe and don't look at all like the stock market. Forget the gold and silver miners for a minute. We'll get on that later. But in the commodity-related area, commodities look to us like they're starting a second wave up. Now, the first wave came from a low in 2020. Bloomberg Commodity Index then traded below 60. Put that in context. Bloomberg is a broad commodity index, very well weighted. It's not overly energy and so forth. While gold doubled in price from 2015 to 20, commodities continued down. Not precipitously, they'd collapsed into 2015, but they bled through 5 more years to the summer of 2020. In October of 2020, we put out an explosion signal, commodity explosion, and commodities doubled in price. But even from that low, below 60, go back and look at where commodities were in 2008, 230 something on the Bloomberg. They made a low at 60, and when they went to 140 in early 2022, most of that occurring before the war, by the way, even at 140, it was still very cheap compared to the 2008 and the 2011 price highs. And everybody was screaming, her commodities are off the page. No, they're just having a hiccup off of levels that are so low that it's ridiculous. It was they were priced off the page as a category. They've since pulled back to 100 on the Bloomberg. For about 2 years now, they've done this. The most boring asset category out there. 3 or 4% up, 3 or 4% down. They're just absolutely stone cold asleep. And it's reflected in most of the markets within the Bloomberg. Last month's close on the Bloomberg caused us to put a thumbs up on quarterly momentum of the Bloomberg Commodity Index, meaning it's no longer asleep, it's waking up. It looks like it's now ready to join gold, something it hadn't done between 2015 and 2022. where it went down through 2020, and it went up, and it actually went up from late 2020 to early 22. Gold was going down during that time in a range. So it was totally opposite. But right now, I think commodities are about to join in sync with gold. What does that mean? In the stock market, you've got your energy stocks. Everybody knows about that. And they look poised to participate. And there's also ag-related stocks, agricultural-related. There's an ETF called MOO, M-O-O. It contains companies that produce agricultural-related products, including fertilizer and so forth, tractors. And it looks to us like some of those categories will go up nicely in accompanying the commodity upturn. And they're safe places to be within the stock market, not what we call the normal stock market, but still the stock market. But we think that 2025 is going to be the table-pounding year for gold and silver miners.
As volatility escalates, gold remains the ultimate hedge, offering stability in an increasingly unpredictable world. Silver is garnering increasing attention from investors in 2024 and 2025 due to a convergence of positive fundamental drivers. As gold, silver, and commodities align for a breakout year, how are you positioning your portfolio to take advantage of these emerging trends? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.